This is episode 269 of the Andrew Hines Real Estate Investing Podcast. Welcome back to the show. Today I have Jordan McGregor on, and Jordan McGregor is an investor out of Kingston, Ontario, an absolute wealth of knowledge, been investing for over 25 years. And Jordan laid it all out on the line. This guy is very much a doer. He's very aggressively building his portfolio and building a business with a calculator for BRRRRs. He's developing land. And then also acting as a realtor. So he's got his hand in many pots, and he spent some time with me today, and we had one of those super casual conversations about real estate, where we think the market's going, what he does, why he does what he does. Like somebody like him, been in it as long as he has, you certainly don't really need to be doing, active building of your portfolio anymore. If you started investing 25 years ago, you got such great deals that you could live off the cash flow. But he wants to keep doing it. He wants to keep pushing forward. And he had basically a philosophical response when I asked him that question, which you can tune into the episode to hear. And I really enjoyed talking with him. At the end of the episode, we went through how his software works to do BRRRR calculations. And it does a lot of things that some of the spreadsheets that I work with do. But it kind of trying to simplify it and making it super user-friendly, which is one of the things that I admit, like working with complex spreadsheets, I don't always love it because, you can get into some really intricate ones, but it gets confusing to work with them. I like quick and dirty from an initial standpoint, but then once I find out a deal is worth evaluating, now I want the complicated sheet. If there's a lot of variables, if it's a multi-year plan and I'm trying to figure out how the numbers work, I'm going to want that sheet. And so Jordan talks about that. We talk about why it's so important to have your numbers down when we're in the climate we're in today, where the market appreciation is not likely to save you. I mean, anything could happen, but I don't think it's likely to save you. So, like I said, good talk filled with gold nuggets. I think you're going to like this one. So just before you jump into the episode, if some of the terminology I use is new to you and you're not following along, I'd highly recommend check out that first 10 episodes of this podcast, because it was sort of created as an instructional video or series of videos. And then come on back to modern episodes and continue on, and you should have a much better grasp. So with that said, let's go ahead and jump into the episode with Jordan McGregor. Hello and welcome to the Andrew Hines Real Estate Investing Podcast. I've got Jordan McGregor on for a virtual episode, first episode in the new studio. Jordan, thanks for doing this.
Oh, it's a pleasure to be here, Andrew. Thanks for having me.
I'm looking
for a while now.
Looking forward to chatting. I know I had to reschedule on you once, so but as you pointed out before we got started here. I don't really know about your story. I don't know about you. I know you did reach out to me and I thought it'd be a good fit, but why don't you give me the backstory about you as a real estate investor? And then I know you have a business, an AI, I believe, business around real estate. So tell me about it.
Yeah, no, I appreciate that. My Genesis story, so to speak, it actually wasn't intended. I think a lot of people, I knew nothing about real estate. I was relatively young. I was 17 years old, and my parents had just sold a small business they had. It wasn't overly profitable. They got a couple of bucks, and my mom was like, you really need to get into real estate. And I was like, well, I'm totally happy living with you, so I don't know why I need to get into real estate. But my parents talked me into picking up a little townhouse. And I quickly realized that, holy smokes, like I can own this property and I can rent out rooms. And so, not that I knew what I was doing, but I was house hacking and realizing that I could have my mortgage paid for me and not having to, have the money necessarily to cover the bills, and I could save money. And that's what I did. And again, I had no clue what I was doing. I was super green, very young, probably extremely immature. But, I made it work, and I was pretty strict with my dollars, and I saved and saved and saved, and then bought another townhouse right next to me. And then I just rented out all the bedrooms to St. Lawrence students. I live in Kingston. And that kind of started my journey. And the more I got into it, the more I learned. I was attending seminars, events, conferences. I was reading books. I hired a coach. And it got me into, operating at a relatively high level at a young age. And that's kind of what got me into it. And I did take a bit of a brief hiatus from the investment part of it. I became a police officer in Toronto for about 9 years. And while I was there, I started buying more and just, continued to educate myself. And eventually I just, said to myself, what am I doing? I'm working for, I'm working for somebody else. My schedule's not my own. And then I just said, what, I'm going to give this real estate thing, a real hard go. But I became a realtor and ended up being really good at it due to my experience over the last 15 years in real estate investment. And I started, counseling people, providing direction, helping people with purchases, starting off on small multi-units, and it worked its way up to massive apartment complexes, which, now we do consult with institutional buyers, REITs, funds, syndicates. And and that's what got me into it. It's been great. I've been buying and selling throughout my entire journey. Started off, like I said, with a small townhouse, which turned into a couple of duplexes, which turned into your triplexes, your 5 units, your 10s, your 12s. Now we focus a lot on land development, but that was my story. Yeah, it was very fortunate to get involved in real estate. And it wasn't necessarily the trajectory I ever thought I would head on, to be honest with you.
And like, how long have you been in it then? Has it been like 20 years since you bought the first property?
Yeah, I'm coming up on 25 years, man. 25. I'm dating myself. I'm 44 now. So, I was 18, 19, so 25, 26 years actually when I first got into it. And it can multiply quickly if you do the right things. And I think that's what led me to, get into the software end of what we do, which is, we help people conduct thorough evaluations on properties. And Andrew, I know you're a real estate investor yourself, and I'm sure you have, you've seen the interesting pro-formas and income and expense statements some people, put online, and you're missing. You're missing, management and maintenance, and every expense seems to be rounded miraculously. It's like those are issues, and and a lot of young investors don't understand that. It could be their first property, and they are relying on, unfortunately, a realtor who may not necessarily have the experience in investment real estate. And there are some fantastic agents out there who are very good at what they do, but truthfully, they're few and far between. It's a bit of a niche, right? So, you really got to make sure that you're working with someone who knows what they're doing. But more importantly, you need to have a good understanding of how to conduct your valuations. And that's what we ended up building. When we built it out of a necessity, to be brutally honest, it's, we were using relatively complicated Excel spreadsheets. I've seen the spreadsheet that you have for your people to use, which I think is fantastic. But I think when you get into more of the high level investing, you get into your purchases and rehabs, and you get into your refinances, your typical BRRRRs. There's a lot that goes into the forecasting, the analysis of that property to ensure your project is going to be executable, right? And you have to remove that confirmation bias, and I've seen this done time and time again, where people, they really want that property to work. They really want it. And miraculously, the numbers end up working out the way they want, but that's on the 10th revision where they've reduced the expenses and they've pushed the potential income to the upper limits of what might be possible. And so, we decided to build something that kind of cut that out and really open people's eyes to be able to do a really thorough evaluation, say, hey, listen, yes, this makes sense, or no, it doesn't. And and that's what we've done successfully, mind you. It's it's a pretty fantastic piece of software.
Okay, and we're going to dig into that a bit more in a moment. But I was just on this topic yesterday talking about this exact same thing. And what's the appropriate model to use for your evaluation? To me, my sheet is good for quick and dirty. Like, if you just want to take an initial look at something and decide, does it make sense for me to look deeper? And if it works at surface value at, a quick 3-minute review, which I literally do fill in the values on that sheet in like sometimes less than a minute. Hey, let's just make some assumptions and see if this is even in the ballpark. Okay, now we hone it in. If I'm getting ready to do a deal, now I'm going to be really breaking it down, making sure I have exact figures. But as you've pointed out, and maybe you have this in your software, but there's a lot of nuance. Like, what's your plan? Is it a 5-year plan? If it's a multifamily, like how many units are you turning over each year? At what time will you refinance? Yeah. Like there's so many variables. And no simple sheet could ever capture all of that. Yeah. It would have to be a very complex model, which I've never built. I mean, I could, it'd just be time, and I'm not really that keen on doing that right now. I'd rather find somebody like you who's built that.
You don't need to build.
Yeah.
You did, yeah.
Or I just take somebody else's. Yeah.
Yeah. It's funny you said that, and I think what you're referring to is what's your exit strategy? And, so many real estate investors, they don't have a strategy. They don't have a plan. They purchase the property not knowing what they want to do with it. And I think that's another fundamental error in what they're doing as well. And, I noticed that you coach people as well. And I mean, obviously you're a very high level. Most people aren't though. And so, they need that advice to be able to formulate a plan. What's my plan going to be? Who's my team going to be? What areas am I going to be focused on? Do I have the education and the experience necessary to actually execute this, or should I be partnering with somebody? And most importantly, what is my exit strategy? And, sometimes an exit strategy doesn't have to be a sale. Everybody thinks that has to be a sale. But, for me, typically my exit strategy revolves around a refinance at some point to pull back my initial investment. And then my properties are blanketed with an insurance policy. So on my passing, any taxes related to those assets are paid out. And so then my heirs would be, or my successors would be inheriting what I have. But I mean, that's high level too, right? Most people don't plan for that, but for me, my exit strategy is always a refinance.
I think that, You've pointed out that some people do that. I don't know if that's still the case, and I'd be curious if you still see people doing that today. Because, I mean, now and I said this, we're about to release a book, and one of my lines from that book is that all the fanboys and fangirls are gone. Like the people who aren't really serious, haven't really done their homework, aren't even really getting started anymore. Yeah. It's the ones that are serious, are doing their due diligence, that are going to get into the market, in spite of how hard it is now. That's my take. I could be wrong. I'm curious what you think.
Sorry, were you referring to having an exit strategy planned out?
No, I'm referring to who's getting into this business, and the people who come in. Yeah, I guess to your point. Yeah, not having an exit strategy, not really being that serious, not having thought what this is and why they're doing it. Do you see that a lot? I mean, I guess, because I'm kind of in my own bubble, so I don't necessarily see it. Do you see it, like that there's people still getting in that have no plan?
Yeah, I do. But what I'm seeing, and which is really interesting, over the past maybe 5 or 6 years, I've seen a lot of master classes and groups and summits pop up, and I see groups and organizations which are providing a base training at a significant fee, I might add, although, some of them are worth it. But, I'm seeing in Keyspire, I mean, I'm sure you're well aware of Keyspire, where they've created this massive organization. We've actually provided a lot of consultation with Keyspire and their members and their investment component of what they do when they were working with realtors all across the country. But, they break it down where they provide a base level education. You can be kind of like your sole proprietor, and you go out and you buy your own property, undertake your own management, and you're your own money partner. But they've created this environment, which is now very popular, where your community has working partners and money partners. And what I find is, the interesting part is I see a lot of the working partners having a better understanding of real estate than the money partners. And there's a lot of people coming into this who have no clue about real estate. They just think, I think I want to be in real estate, but they don't want to have to do the hands-on of it. I don't know if you're seeing that at all where you are, but it's becoming quite popular where I am. And we do provide a lot of consultation to some of these groups as well, all over Canada. And I see a lot of people getting into real estate. A lot of corporations too. Like, I'm privy to all the statistics, and I see a lot of corporations, buying new home construction. I think the last stat I read was 40% of all new home construction was being purchased by corps. But I mean, people are still getting into this. I mean, as a matter of fact, I think more people are getting into investment ownership than ever before. It's just, it's so mainstream now.
Interesting. Yeah, I mean, I've seen a fall off in interest in general in sort of my sphere. There's still those that are interested, but it's the ones that were sort of on the sidelines watching, like their uncle made $300,000 on a flip and they wanted to do it too. But now they start hearing all the stories about the people who, are insolvent or lost money and, they took their knocks, right? Because in the transition with high interest rates and values coming down, a lot of people got burned and we're having trouble. But yes, of course, there are still people who want in and are going to do it. And I actually think they're coming back in Ontario. I think it's becoming, people have sort of accepted the new rate climate and they're ready to find a way to make it work anyway. And doing their numbers is going to be that much more important because you really got to have a plan for sure, more so than ever before, because the market won't save you. There's no special appreciation lever that's just going to erase all mistakes, it's even erased mistakes for me on projects in the past. So I can't say I haven't been a beneficiary, but I'm not banking on that for going forward. That's for sure. Are you still a realtor? Sorry,
I am. Yeah. No, not at all. So I'm still a realtor. A lot of what I do is, heavily predicated on investment real estate. Like I said, we work. I mean, I have a team, so part of my team does a lot of residential, but I'm almost 100% focused on investment related real estate. So small, medium, large, multi-unit acquisitions. We work all over Ontario, and we're into a lot of land development as well, all over Ontario, which is, to be honest, really exciting. There's a lot of interesting. I'm sure you're well aware of the CMHC MLI Select programs, even on new construction. It's I would consider those like a Class A asset. Are really interesting. And that's where I've started to move my focus over. I've gotten out of the the C and D class type properties, where they typically the economic life is limited. There's a lot of improvement required. The tenant profile is shoddy. I'm past that now. One, just because the stress is I'm as you can see, I'm going gray prematurely here, but I'm done with that. It still has its place. So a lot of my younger clients they have the palate for that type of risk and stress. It's and you made another point too, that magic lever. I'm curious what you think. I see with some of these MLI Select programs from CMHC, you're seeing 40, 50-year amortizations. I'm curious what you think about that being brought into the traditional mortgage market and seeing amortizations extended with the anticipation of keeping rates higher.
Yeah, I mean, it's very possible. I see them starting to do some things to help make home ownership more affordable, knowing that it's not likely that values are going to come down to an affordable place anytime soon. But with that said, you keep throwing people into this country. It's hard to imagine it's going to bring real estate within reach anytime soon.
Yeah.
I just think the competing effects. Yes, you have immigration, but the higher interest rates have just made it unaffordable. And we still have probably about 2/3 of borrowers have not yet renewed into a higher rate yet. So you still have, last time
you make a very good point. That's scary, actually.
3/4 of borrowers are still in, under 3% mortgages. So when they come around and renew into the 5s, now they're going to be listing properties. You're going to have immigrants and, new to Canada is buying up those properties. But, we could potentially see a slow and steady slight decline, or we could see a stagnation, or we could see a slow and steady slight increase, or I could be completely wrong and we see a spike. I don't really see that happening unless they decide that they're going to go ahead and they're just going to drop rates because of the economic turmoil, which is hidden right now by the fact that we bring so many people into the country, so it appears that GDP is rising, but GDP per capita is down significantly, which means on an individual basis in Canada, the average person is getting poorer. The output of the average person is getting lessened. So that's not good. But the U.S. is not doing that. So you asked me, so I'm telling. The U.S. is not doing that. Their GDP per capita is still going up. So it makes the U.S. less likely to cut rates. They have way less pressure to cut rates than Canada does. But Canada can't just cut their rates, because if we do, we now Well, the correlation is if your interest rates are lower, it devalues your currency, and if your currency is worth less against the U.S., that means we're now buying more expensive goods, which is going to cause inflation more. So, vicious circle. I hope everybody was interested in hearing all that, but those are my sort of expanded thoughts about the complexity of the issue. So it's really going to be a wait and see. What does the U.S. do? If they cut their rates, then maybe these extended amortizations aren't as needed. Maybe they'll happen. I think it's very possible, because it wasn't that long ago that they reduced the but the CMHC insured amortization from 30 to 25 years. And actually, when I got into the mortgage biz, it was 35 years. So you could do 35 years. So they could very easily slide that right back out, and it would help people buy their homes.
It makes me wonder too. I mean, you bring up a lot of good points, and it's like, what are they going to do? Are we going to see some, quantitative easing coming in? I'm not so sure. I'm kind of with you. I was cautiously optimistic we were going to see a quarter point pullback on the last announcement, but obviously that didn't happen. And the only thing I can think of is, like you said, we have a third of people coming up for 30% of people coming up for renewals this year, I believe
it's like, a third or 25%. It's in that range. Each year.
It's a huge number.
Will renew into, your 5% range.
Your 5% range. And what's the solution there to curb the debt load you're going to be taking on? It would be, and the only thing I can think of was the extension of the amortization, but you'd have a stricter qualification process on new purchase. And I think I read something, was a couple of months ago, that they changed the stress test on refinance now, where that no longer applies as well.
I didn't know that. I just heard that they're proposing to limit something along the lines of 4.5 times your income will be the most mortgage you can qualify for, regardless of what the rates and, if rates fall. I've heard that. I have not dug into this yet, but I wouldn't be surprised. This tool is already at people's disposal. If you're out of the high ratio territory, like if you're less than 80% loan to value, then you can go and you can refinance your mortgage at renewal and not even take more principal, but just refinance it so you can take that amortization back out to 30 years. And that's at people's disposal right now. So you can work through this. Not everybody's going to go race to sell. The less educated or the more in a financial pinch might, just for quicker access to cash, but that might not even put cash in their pocket quicker, depending on how long it takes to sell and the status of the market at that point. Again, when I look out at the market right now, I just see it as a place to do business. I think that there's going to be great deals out there. I think you just got to buy smart. You got to buy with a plan in mind, knowing that values could stay right where they are for the next 5-10 years. Yeah. Or they could even go down. So what's your plan? How do you make that a winning deal in spite of those potential variables? Oh,
that's such a good question. And again, for me, it's, I've learned the hard way. When I was younger, I've done a few bad deals, and it's, to the point where you don't want to experience that again, which is why I'm really critical when I undertake my evaluations. And I also leave the emotion out of it. For me, it's, there's lots of opportunity out there. You just need to know where to look. You need to have the right contacts. And, when an opportunity presents itself, I'm really critical on that, on how I do my evaluation. And if the numbers make sense on every stage, so the way I do it is I have my purchase phase. So I'll undertake my evaluations, certain metrics I look for. I have my rehab phase. I've built out a stabilization component to our software. So like I can forecast, like I just picked up a 16 unit, and we have an offer on a 48 unit as well. And I can forecast, what is my stabilization going to be on this building? How many years do I think it's going to take me to reasonably flip a certain number of units? So we've built in those formulas into the system. So, when I'm looking at my purchase through my rehab, then when I get to my refinance, I have a pretty good idea of where I'm going to be sitting when I go to pull money out. But it all has to make sense from the purchase. Like, gone are the days of buying based on speculation. I think that's really, really dangerous. Gone, in my opinion, are the days, and there's still people teaching this, which I'm shocked, where they're 100% loan to value properties, where they're getting into first and seconds, and they're 100% leveraged at 15 to 18%. There are people that teach this, and it's like, it shocks me, because if you had bought anything during COVID, when the rates were pretty high, there's no way you're going to be refinancing out of that. I don't know what they're going to do.
Yeah.
So,
and I'm sure there's many people in that situation right now that
yeah.
they took expensive money and then they were underwater.
Yeah.
And it was out of their pocket.
Underwater. And now you're robbing Peter to pay Paul. And so for me, I don't get into that kind of real estate.
Yeah.
It looks attractive sometimes because you're getting in with very little money, and, you know, on face value, your ROI would be reasonably high. But, you know, if you have no exit strategy on that and you can't flip that to a conventional mortgage and be cash positive, then you're going to sink on that. So for me, every property, you know, I'm very critical of it. And, you know, like I said, what I'm into now is land development. I love it. It's really easy. I have really good contacts. There's some great deals out there. I'm really familiar with the zoning process. We have great contractors and builders we work with, and, you know, we're buying little pieces of land all over Ontario, and we can put really nice purpose-built multi-residential product on there. You know, but for a lot of our younger clients, like, again, we still work with, you know, your average person. I'm big on that single family conversion to multi-unit. And I think it would apply to your area as well. You can take a single family home and convert it currently to 3 units.
To 3, yeah. And then some you can do the laneway house. And then in Toronto's jurisdiction, I think you're now 4.
4,
if I'm not mistaken.
And that's coming here in April as well. And so for me, I mean, that's a great opportunity. I toured a property with a client the other day, and it's perfectly set up for, it's a single family home, but it's easily converted to 4 units. That to me is a no-brainer. I mean, your interior conversion cost is, you know, you're under $100 a square foot. Why wouldn't you do that? I mean, to build new, you're going to be pushing $300 to $400 a square foot. Yeah. So, I mean, that's a great opportunity. You know, a lot of these young people think, man, I can't get into real estate. You can get into real estate. You just have to have a good plan. How are you going to do it? I would do it just that way. I would be buying a single family home with a decent footprint that I could, you know, over time convert to a multifamily property. That's what I would be doing. I mean, if I had a choice, if I were starting brand new again.
Right. What do you, and to your point, like I've never wavered on, you got to have cash flow, and you should never need to speculate on value. Like if you only get your cash flow and your pay down, you need to be happy with that.
Yeah.
So purchase price, if you were going to get something to convert to 3 units, like, have you done a project like that recently? Like, are you aware of something like right now that works for that? Because when I run those numbers, they can be touchy at best, because it's not cheap to get renos done, as you've pointed out. Of course, it is cheaper to reno than it is to build. Like, what are we looking at purchase price wise?
Oh, good question. I had a client just pick up a really large semi-detached. They were 360. I have to remember that my partner sold it 360, I think, was the purchase price.
And that was in Kingston?
That was in Kingston. Yeah. It was a great deal. And they're putting in 2 units in the lower level, 2 1-bedrooms. And the quote we were looking at was 120, I believe. It? And that included M-post fees. Yeah, it was 120. It was really reasonable. I'm just curious. I'm just going to work out what the square foot cost was on that. Mm-hmm. Yeah, they were $85 a square foot on that.
Okay, and what do you think that that's worth on the open market if you were to put that for sale?
Good, and I think it depends on how you're undertaking your evaluations, right? I mean, you talk to a lot of people and they say 4 units and under, you're a single family direct comparison approach. I would argue that, you know, as soon as you're drawing an income, I mean, single family, yes, but when you start getting into duplexes and triplexes, a part of your value is predicated on what your cash flow is on that property. And so
for sure.
I would probably implement some type of an income approach, and I would be bringing in some type of a cap rate associated to it based on the area and the quality of the product. I mean, we have a rather large client here who's just unloading a part of their portfolio. They're getting into larger multi-unit developments, you know, and we're hitting six caps on decent product. And these are duplexes. This isn't like anything special. This isn't like I mean, we're between the 6 and 650 range on some of these properties, which is still, in my opinion,
650 for a duplex.
Yeah.
So a triplex might go for 7. So a
Yeah.
triplex might go for 7. Yeah.
Yeah. Again, it all depends on the quality of the product. And
Yeah. Okay. So
like,
this one, what you know of anyway, do you think it would be in that category, potentially like a $700,000 value?
great, but yeah,
Okay.
I mean, it's phenomenal. So no, so the semi-detached I'm referring to, you're probably going to be looking at a $640,000 valuation on completion, which
Okay.
I mean, given, doing a direct comparison approach,
Yeah.
based on the single families that have sold, it's going to seem really high.
Mm-hmm.
When you do it based on the income approach, it's a no-brainer. It makes sense. It's cash flowing at 6% interest, so it's a good one.
Yeah, there's enough appraisers out there that understand income properties.
That's right.
I think that'd be okay. What do you figure that would do per unit? Like you have your main unit. What's that going to fetch per month for rent?
Yeah. So what this particular client did, which I was pretty impressed with. So I find a lot of people to cut costs. Like in this particular property, there was one hydrometer, there was a gas furnace, ductwork. They removed it all, and what they've done is they've gone with independent heat sources in each unit. So each unit has base
heat pump,
forward heat, but then it has a heat pump. Yes, exactly. And so they've stratified the utility completely. They've even separated the water. And so they're getting what their projection is 2,200 plus for the 3-bedroom up. And the 1-bedrooms, they projected 1,700 each. It's in a fantastic location, close to the university. So they're looking at 1,700 plus.
Oh, students then?
No, not students. You're young professionals.
Young professionals. Okay.
There is a student market. The rental market in Kingston is really strong. I mean, worst case scenario, you're going to be 1,600 plus. They're lovely units. They put a lot of attention to detail into the overall fit and finish of the product. Nice quality, good size rooms, really nice kitchens, really nice bathrooms. Like it was pretty slick. That they weren't huge, but the quality was on par.
Okay, good to know. I'm just going to run some rough numbers, like taxes. Would it be safe to say that's going to be around $3,500, $4,000 a year?
Yeah, I'd have to check on what the exact taxes were on that unit. I think it was less than 3,000, 29 something. I could pull it up.
Yeah, they'll probably reassess. No, I'm just trying to get rough numbers. I mean, worst case insurance is probably going to be around 2,500, maybe 2,000. But
you have your
conservative.
Maintenance.
Yeah, so maintenance, I got 4%, reserve allowance 2%. I've got management. What do you figure for something like that? Is it going to be 6-7%?
I do it at 7% plus your
7%. Yeah. All right, so we'll put 7.25. Cover that ish. Utilities, he's not going to have anything. Landscaping and snow, anything like that?
Yeah, and that's required when you have a multi-unit property. It's
probably $2,000 a year.
Yeah, I think with the window you're back 2,000 at most.
Yeah,
small yard.
And then I just like to keep miscellaneous $500 there. So yeah, I got like a 7.28 cap at 640,000.
Yep.
So it would make sense that you could get a nice first mortgage for, say, you're going to probably get 80% with the bank. And
depends on your risk tolerance too. I mean, you can do a lower loan to value. Yeah,
sure. And you'd be at 6% probably on the interest rate. Yeah, and you'd be cash flowing 835. Yeah, so that's a rare deal.
You know what? it comes to the intensification ability, and that's why I'm big on so not just converting to a secondary dwelling unit, like an SDU, but if you can add a tertiary unit or even 4 units in your property, there's still money to be made out there. And like you said, Andrew, there's going to be such a demand for rentals, and there's a lot of the younger generation. I can't remember the poll, and you can fact check this if you want, but a lot of people think they're never going to be homeowners. A lot of the generation think they're going to be renters for life. And that's interesting, right? So if I think there's still going to be a demand for a good quality product. And if I were a young person, I'd be looking for a single family with intensification potential.
Yeah, that's a great point.
Yeah.
That's a great point. So this deal that you're showing me right here, is that still something that could be found on the market in Kingston?
Oh yeah. I mean, I think it can be found in a lot of locations. Municipalities are, as per the province's direction, is they're looking pro development. A lot of that bureaucratic red tape has been removed, and I mean, we've undertaken a number of these conversions recently for clients, and it's night and day. You know, I did a conversion for a client, must have been 4 years ago now, and it was almost 2 years in the planning process to go from a duplex to a triplex. 2 years.
Holy crap.
And it was an $80,000. We had to do a ZBA, so a zoning bylaw amendment. The total cost was around $80,000. And now all you need to do is simply pull a permit I mean, it's
Yeah, now it's as of right. Yeah.
yeah. So it's
So that does change things. Like how much of, and I wonder for somebody who's been doing real estate as long as you've had the, you're wise enough to get in at a young age. And
lucky is when not wise. I can assure you I was not wise.
So you stumbled into it at a good age, but I mean, I'm sure now you're at a point, and it depends on lifestyle. You're at a point where you probably could just live off that income if you wanted to. Like, what is it that keeps you doing what you're doing?
You know what, Andrew? That is, I think every person comes to that point when they have to make a decision. And I have a young family. Like I'm married, I have a wife, I have an 11-year-old and a 12-year-old. And not that I was given an ultimatum, but at some point, what do we do this for? Right? I mean, you do it to hopefully be able to benefit from a better quality of life. And I think for a lot of people, ego gets in the way and they think they have to keep going and going and going and going. And the fact of the matter is, I mean, you don't. I've gotten to a point where I now do the projects I want because I truly get a high level of satisfaction when I can build out a really nice development project and I'm providing a really nice rental stock for people. And I don't overcharge. I build really nice product. I like that. For me, I'm not chasing the dollars now where I'm necessarily trying to refinance every single penny out of a project where, it's highly leveraged and I have minimal cash flow. It's for me, I've slowed down considerably. And as a matter of fact, what I've noticed, the biggest thing I've noticed is my risk tolerance has dropped significantly. You go back 15, 20 years ago, I mean, I would take on some projects that truthfully I could have went one way or the other. It could have broke me. But it ended up pulling it off with luck, to be brutally honest, and I'll never do that again. And I think you get to a point too where you're like, you get comfortable. And I don't think people say when you're comfortable, you stop growing. I don't think that's necessarily true in this. I just think you start to make, more sound decisions because you have other people to think of, right? Mm-hmm. My wife, my kids, it's, and so, for me, I've slowed down a lot. That's a long-winded answer to your question, but I look
no, it's good.
I look for projects where, I like those Class A style properties where, they're constructed after, November 2018. There's no rent control. They're good assets. I look for concrete structures. I look for something that's going to be no maintenance and no headache. I don't want headaches anymore. I don't know about you, but I'm curious about you.
Yeah, I don't like headaches either. I actually sold off my Ontario portfolio and then invested into a hospitality business, which is actually ample headaches. So that's a business attached to real estate. So we're building that out, and then I'm also building out an enterprise in the U.S. in Florida. We do land flipping and houses. I built a few houses down there. Market got squeezed a bit, and just decided that wasn't the way I wanted to go. Too much risk, as you pointed out, for very minimal profit. So just changing my approach with what I do there. But for me, I looked at the passive strategies that I was taking, quote unquote passive, and building a rental portfolio slow and steady, and it just wasn't working in today's market at the pace I wanted it to. So I had to re-gear a little bit and redeploy.
Interesting. You're done with the Canadian market?
I'm largely done. I mean, I would take a deal here if it fell on my lap and it made perfect sense. I'm thinking out loud with that. Like, I don't have anything in mind. The hospitality angle was, totally outside of the landlord tenant laws in Ontario. So I liked that. But I just looked at the US as a place I like going, Florida specifically, and a place where I saw a ton of opportunity. And it wouldn't hurt to make US dollars and spend in Canadian, that's for sure. So there was just a number of things that I liked about it. And I see 10 times the amount of knowledge base and opportunities down there. And of course, if you could take some of what they do down there and bring it back to Canada, it could be a really great recipe. So I'm not closed off to it. It's just not my focus right now.
There's better deals in the States. I had a conversation with a gentleman the other day, and he owns 1,000 doors, really interesting guy, loves the US market. their debt servicing ratios are totally different. What's acceptable? Their loan to values are completely different. They're not as highly leveraged. There's a lot more cash flow. It's really interesting. It's a really, really interesting market. And I've seen quite a few of my clients have shifted into the US. We don't provide service there, mind you, but I think there's a reason for that. It's interesting.
It's become so popular in my audience. Like I hear all the time people going into the US. I see all these people on my Instagram doing stuff in the US now. I first invested in the US in 2012 and then I got out in 17 and then I got back in 2021. When I saw the lockdowns happening and stuff and we went down to Florida and they were still open, I'm like, okay, I'm going to start investing here because I just I liked the idea, the politics, the mentality. Not like I'm pretty much apolitical. I don't really care. I'm not getting into it, but I liked the mentality of the people. They were, let's stay open, let's live our lives. Yeah. And I thought that's probably a better place for me to grow for now.
It's funny. I mean, my wife and I have looked at the States as well, and we haven't made that move. We're actually looking towards the prairie provinces right now. Saskatchewan, I find, is a really interesting market. Some phenomenal deals into Alberta. Saskatchewan specifically, though, I was reading probably would have been 6 or 7 months ago. They're anticipating a 30% increase in population over the next 20 years. 30%.
I can imagine because it hasn't been the popular destination, right? Everyone goes to Toronto or Vancouver, Montreal. They're not thinking, Central Canada. Well, that's actually creating an opportunity there for sure. And I've heard good things about Saskatchewan.
It's actually beautiful. My brother-in-law lives out there and he travels back and forth. You get a house for 150 grand there. You can buy multi-units for $80,000 a unit. And it's like, and you're looking at 7-8% cap rates, like undertaking proper valuations. Like it's a really, really interesting market.
Yeah, that's appealing. You'll have to share more if you dig into that. Cause I've had maybe one person, maybe two, come on the show and talk about investing in Saskatchewan briefly, but I'd love to hear from somebody who does it more. I feel like they're keeping their mouths shut because they like the opportunity. Everyone around here, like if you're not going to the U.S., you're going to like Alberta. That's very popular. But I've looked at the numbers in Alberta and they don't really seem to blow the socks off right now.
I agree.
Like they'll work and they're probably a hair better than here, but their values have adjusted as well.
I think it depends too on, where we spoke about exit strategy. And, if you're a typical burr investor, if you can pull back the majority of your investment, it makes a lot of sense. A lot of my investments, I've done a full recapture of my initial investment. And so for me, it's a no-brainer. I truthfully, on a lot of our new developments, that's how we're structuring it. So, we're building 30, 40, 50, 60 unit buildings and the way we're structuring it is it's a private on the build, and then you refinance into CMHC.
Yeah. Not the MLI Select program, though?
MLI Select program, yeah.
Now, they don't like construction, private specifically, right? They're going to put you in that 2-year hold.
Yeah, so we would be with like a private, you're 100% correct. So if there's a private, you're not going to refi, or if there is a vendor take back on it. So it has to be a construction-specific mortgage.
Yeah, through an institution.
Yeah.
Could it be a credit union?
Yes, credit unions, yes.
Okay, so you're doing it that way. That's seems to be the way to go now. And so obviously MLI Select gives you the ability to go the longer amortizations, better interest rates. Are you guys taking the 95% loan to value, or you said you're going more conservative?
So on new construction, yes.
You'll take it.
The buildings are tight. There's still really good cash flow on them. But on some of the older products, we just had one that we locked down, was a 16 unit, and it was, $4 million purchase price, kind of high for a 16 unit, but it was brand new construction. And it was it was $190,000 down payment. It was I think less than 5% or right on 5%. So it was 95% loan to value. It was a phenomenal deal, and it was, a great cash flow. So it's
it's amazing.
That's MLI Select all the way. And there's some nuances to that as well. People think, MLI Select all the way, easy home run deal. It's not as simple as you think it is. When you have to have the energy audit, right? Or you have to do it based on affordability or accessibility, right? So you need 100 points. The key is to get 100 points on it. And so it's not every property will fit the bill for that MLI Select.
Yeah, for sure not. But if you're building from scratch, you can get the energy.
Yeah, that's right. Yeah. And
So
typically accessibility. Yeah.
what type of units are you doing? Like, are you doing 4 units, 8 units, 16? Like, what's your typical land development play where you're building it out? And is that for you to keep, or is that something that you're selling on the market?
Keep. Yeah. So keep all of them.
Okay.
Like right now we have a 60 unit that's before council. So for draft plan, we have a 36 unit, we have a 70 unit. And obviously depending on the market, but we're building at 1s and 2s, 1 and 2 bedroom units. I stay away from the 3s. And then depending, like in our municipality, for example, they're big on bringing in some type of affordability. So we're creating a number of bachelor units as well, so we can bring the cost down. And it's great. I find the 1s and 2s are your highest bang for your buck on your rent per square foot. I stay away from the 3s. They take up too much square footage for such, a marginal increase in income.
Yeah. There's not as many people looking for them either.
Yeah. We typically get rid of those. Good amenity space. As far as construction, the 36 we have underway that's a stick frame with a concrete overpour on the floor. It's really expensive right now. So obviously there's a requirement to try and keep some of the costs down. Mm-hmm. But stick frame currently is the way to go for us. One of the other projects we're looking at is going to be a total concrete project. So it really just depends.
Yeah, the concrete would be a lot more.
Yeah, a lot more. But you also have a higher economic life as well. It's just and if you ever want to sell to a REIT too, they don't like stick frame stuff. They want concrete. So, again, you talked about exit strategy, right? So it's, yeah.
What kind of difference in a per square foot cost are you talking between stick frame and concrete?
100 and a quarter.
Like a whole 100 and quarter more.
Yeah.
Wow. Yeah. And you can make either scenario cash flow with what you're building?
You know what? So when we've run our numbers on both, there'd be a requirement to keep more money in the concrete product. For sure. But if you had built 4 or 5 years ago, mm-hmm. it would have made sense. It's just the cost for the product is so much higher right now.
What are you paying per square foot for something without a parking garage, no elevator,
stick frame?
Stick frame. Yeah, stick frame.
280.
280 a square foot. Yeah.
And even then, I think that's with a general contractor on site. So could you improve cost a bit? Probably, but I don't know about you, man, but some of these building projects can be a bit of a whirlwind. So it's nice to, you pay your, we're sitting at roughly 3.5% you're paying on total build, and these companies will come in and manage it for you. So in my opinion, it's worth every penny.
Oh yeah, totally. So you're paying a general contractor 3.5%?
Yeah.
Oh wow, you're getting a great deal.
Well, you got to remember it's a $10 million build, so it's
so they're making good money.
They're making good money, and there are some additional fees built into that as well. And I would suspect, when the sub trades are being hired, there's probably a fee being built in. A certain percentage of that is going back to the general contractor. Yeah. It's kind of how they operate.
Yeah. Okay. So there could be some of that going on. And have you seen one of those through start to finish so far?
Yeah,
one of these ground up. Yeah. How many have you seen through?
2 from start to finish. We built the first 2 in Ottawa. My partner's in Ottawa, so it worked out quite well. And
how many years did they take total?
So we built a 16 and a 24 unit, and sorry, just my dog's barking here. The 16 unit from start to finish, it was land assembly. So we bought multiple parcels, and that was probably 4.5 years from start to finish. By the time we acquired the parcels, rezoned it, and built, and the 24 unit was an as of right. It was ready to go. So we had bought the property. It was ready to go, approved for a 24 unit, and that took around 18 months. It was pretty quick.
Wow. Okay, that's great.
Yeah, it was good. But again, my partner is very savvy, so it was nice, to be honest. And you learn a lot of things too, and it was super smooth, like zero headaches.
Very cool.
Yeah.
Okay, so we're getting short on time here. Why don't you tell me a bit more about the software, kind of what people should know? Give me your sort of elevator pitch, because it sounds cool. It sounds like something that a lot of people could benefit from.
Yeah, thanks. I appreciate that. And obviously I'm a little bit biased because we built it, but for me, it's having a really good understanding of what you're getting yourself involved with, right? And so understanding the purchase, what cash you're going to require. And again, I think you had mentioned you're able to do an evaluation within a minute. We can do an evaluation within a minute too on that summary page. So it's, I mean, it's, you know, it's pretty simple information. What's your purchase price? What's your income? We can break it down per unit. Or if you want to go real quick, you can just put a gross amount in. Same for expenses. And then we look at that unit and we can set a criteria to, you know, are you looking at the 1% rule, the 50% rule, the 70% rule? You know, what type of cash flow do you want to see on purchase? What do you want your cap rate to be? How much money do you have to invest? And so we've built a bit of a criteria analysis tool, so you can set all that ahead of the time, and then you can do, you know, a summary evaluation in literally 2 minutes, and it's going to spit out the data you need. You know, what's your ROI? What's your cash flow? Your recapture? You know, what's your passive appreciation, and then, you know, other metrics like, you know, your debt servicing ratios and, you know, all that kind of good stuff that you need. And it's broken down very critically as well. We have a lot of spreadsheets that we've built into it, but it's meant to be very visual. So you can look at it and you'll see graphs and bars and figures which walk you through the purchase. And, you know, and then we have, you know, you can view your summary, or you can click on to the rehab component. And that's what I was talking to you before about how we've built in the how to forecast. So for some of the larger buildings, you know, I told you we have a 48 unit that we're working on right now, and we can input in an entire rent roll, and it's time. Again, that part's time consuming. Sometimes there's just not a lot you can do about it. But, you know, as you said, you want to take a quick look at a property and see if it makes sense to move forward on it. And if it does, then you're going to spend more time in doing your evaluations. And so we can actually indicate the number of properties we think we can turn over, and we can just, through a little toggle switch, we can activate it, and then, you know, a little modal is going to pop up with what your renovation cost is, perhaps your cash for keys and your timeline, so we can forecast a proper carrying cost analysis.
Yeah.
And then from there, it's going to provide you another summary page. You know, this is your before and after. This is your new potential value, your new cash flow, all your new metrics. And then if you wanted to refinance out of that, we have another page that you can go to, and it pulls all that data over to what you want your refinance to be. Again, I'm really simplifying it, you know, without the benefit of showing you. It's probably the easiest way to describe it, but it's just a really simple tool. I mean, the complications in the back end, as you know, you built your own calculator, right? So the complications in the back end and how you're programming it and what your algorithms and your formulas are going to be. And so we've tried to make it as user friendly as possible, so people can undertake a purchase through a renovation, through a refinance, and actually track the metrics, so they know, like, you know, how long is it going to take me? 2 years, 3 years, 4 years? I don't know. And so we wanted to bring that to people. And then we have something we're really proud of. We have a little sharing feature too, so you can actually share a property with a partner or your mortgage broker, and they have access to all of the information that you've reviewed. And then a property, a net worth component that's coming. We should have that up and running in about a month, where if you actually make a purchase, you can track your net worth, and it will let you know when you have equity opportunities for future refinances. So yeah, it's a really, really cool tool. Super helpful. It's made my life easier from a realtor perspective when I'm trying to walk a client through a property. I don't have to sit there and do an evaluation on one system and then pull out a piece of paper and try and, you know, show them how the renovation is going to look and what their new value is going to be, and then input that information into the old calculator. And I mean, you're never really getting a true reading of what your ROI is, right? So
yeah, that's fascinating. Maybe we'll get you on our AI hot seat to do a little demonstration of it.
Would love to. I think you find it super useful. I mean, anybody will find it useful. Cool. Like, it's a game.
Yeah, and there's so many useful tools out there. It's really just a matter of somebody taking the time to build out that tool. You know, you can build it in a spreadsheet format, but then it starts to get complicated. So yeah, that sounds like it could be awesome. So where do people find you, follow you? Like, do you have a social media presence?
I do, yeah. Official Jordan McGregor on Instagram. On Facebook, I'm just Jordan McGregor. It's nothing special. LinkedIn, Jordan McGregor as well. And if they want, they can check out the burbot.ai. You're probably wondering why the AI, which is, you're probably wondering, the reason the AI is what we want to do is we want to start pulling data from like Zillow and Realtor.ca and undertaking automatic evaluations for people. And then hitting them with notifications saying that we've done an evaluation for you. You might want to take a look at this property. That's why the AI is there, if you're wondering. Yeah,
I was wondering. Okay, that's good to know. So it's in the works. Okay.
It's just the development, I'm telling you, is just it's a lot of work to try and build all that in.
Of course it is. Yeah, that's good on you for taking on the project, because a lot of people would just not But
for a good reason. Trust me,
yeah,
if I could go back in time, I may not have done this. But
yeah, fair enough.
we're here now.
That's often what people will say. Okay, anything you wish that you had an opportunity to share that I haven't asked you about?
Nothing, honestly. It was this was great. It was nice to chat. Nothing else I can think of, but yeah,
Perfect.
I appreciate
All
it.
right, yeah, I think the same. It was a good episode. Super just casual chat, which I love. I love when we get to have these kind of episodes. So, all right. Well, Jordan, it was nice to meet you, and thanks to everyone for tuning in. And Jordan, let's stay in touch.
All right, my friend. Hopefully, we'll talk soon.
Okay.
Take care, Andrew.
Sounds good. You too. Bye bye.